So anyways, what I was saying is we have a gap up and a bull bar, but relatively small bull bar. That makes me think tomorrow is probably going to be a disappointment bar and lead to a pullback. And therefore, what are the chances that tomorrow is a strong follow-through bar? It probably won't be a strong follow-through bar. And that makes me think that the market is probably going to pull back or at least go sideways for a few bars. We went above this high here and we went sideways. Now we're going above this high. We'll probably go sideways. Yeah, it was Occam's razor. Yeah, same basic concept, but yeah, that's, Occam's razor, someone pointed out, is a problem-solving principle that suggests the simplest explanation is usually the best. And then you could apply that exact same logic to trading. Absolutely. And that's really where I'm getting at, is when you're thinking about a trading idea or strategy, the more simple the decision tree is to get to what you're looking for, the better. So the whole point is when most of the bars are above the moving average, don't look to sell. When most of the bars are below the moving average, don't look to buy. First bar of the day, we formed a doji, and it's a doji bar after a really big gap up. Increases the odds that we may form a tight trading range. Because we're so far from the moving average, I suspect the upside is limited. And because bar 1 is a doji, that makes me think there's probably sellers somewhere above 1. So even if we rally for a couple of bars, unless the bars are really, really strong, it increases the odds that we'll test back to the bar 1 high. 2, follow through, good for the bulls. But like I said, 1 is a relatively weak buy signal bar far from the moving average. In bar 2, it's really not all that great of a bar. It overlaps a lot of 1. 3, disappointment. It's a bull bar, but closed almost at the open and closed under the 2 high. That increases the chances that there's probably sellers not far above and will probably start to go sideways. 4, outside down, bear bar. Good for the bears, but probably buyers below, and we may end up going mostly sideways here. 6, bear bar, closing on its low. Good for the bears, probably test down to the 1 high. What are the chances this is an opening reversal and we get a sharp sell-off? Well, we might, but we need more than just bar 5 if the bears are going to do that. 6, another bear bar, but a bigger bar, more climactic compared to 5. Increases the risk that we may end up pulling back here and get bad follow-through. And then 7, bull bar, but after 3 consecutive bear bars, 4, 5, and 6, I suspect there's probably sellers above 7. And we'll probably get a second leg down. 8, doji. Strong enough. 8, bear bar, second leg down after 5 and 6, but not a great bar for the bears, and therefore probably not many traders selling the close. 9, inside bar. Disappointment bar for the bears. Probably going to go at least a little bit lower. And then 10, bull bar, but not a good bar for the bulls, so we may end up going mostly sideways. 11, consecutive bull bars. Good for the bulls. The bulls see a failed breakout below 1, and they want to break out above the 4 high in some kind of measured move up. Because we had a gap up on the open, and the gap was relatively big, that increases the chances. that we'll break above the 1 high and get a second leg up. So rally, first leg, pull back, second leg up. 12, bear bar, but probably buyers below. And then 13, bull bar, but middle of a tight trading range, still low probability. 14, bear bar, closing on a bear bar, but not a strong sell, so probably buyers below. 15, bull bar, closing on its high. Still not all that clear. And then 16, a bear bar. Is it a wedge with 11, 12, and then 15? Not really. Relatively tight bull channel, and therefore the first reversal down may be minor. 16 or 17, high 1 buy, but far from the moving average at the top of a trading range, probably sellers above. And then we sold off on 18, but 18, what about selling below it? I would not. Most high 1s because we're more bullish than bearish slightly because of the gap up, most high ones lead to pullbacks and then retest at a minimum. And that makes me think that we're probably going to find buyers below the below bar 18. 19, second leg up. After the high one, good for the bulls, but a tail, still not all that clear. And then a bear bar on 20. 20, bear bar, but a tail below the bar. Not really all that ideal. So far, bears are not making money below bars. Let's see if they'll make money below 20. 21, failed. The bulls prevented 20 from triggering. That's good for the bears. That's good for the bulls. 22, a doji, but not a good sell, so probably buyers below. And then 23, bull bar, closing. We finally have a close above the bar 3 and bar 4 high. Good for the bulls. And then 24, another bull bar. We're still always in long. Channel is rather tight. That's good for the bulls, but it doesn't look all that strong. But the reality is bears are not making money below bars, and that increases the chances that we end up going more sideways to up. This might be the start of a small pullback bull trend. Small pullback trends typically look like bull legs and trading ranges that end up transitioning and forming trends. $25 bull bar, good for the bulls. Probably going to go at least a little bit higher, but getting far from the moving average. And therefore, I suspect we'll probably have to pull back soon. And then another bull bar, 26, 27, doji. Again, it doesn't look like it's strong, but why aren't the bears making money selling above bars? You know, it looks easy. You think, oh yeah, if you sell the 15 close, you made money, so bears are making money. And it's not necessarily true. When I think about limit order traders making money, even though the gaps are technically closing through here, it's really difficult. You know, if you sell the 18 high and you don't get out on 19 or 20, you're trapped on the rally up to 27. If you sold the 20 high and you scaled on higher, now you're trapped. And that makes it fairly difficult for bears to be making money. Bull bar, 28. Good for the bulls. First reversal down, probably going to be minor. And you can see we got a bear bar on 29. Good for the bears. But what's happened so far after every bear bar since that 8 low? It's found buyers. 30 consecutive bear bars, 29 and 30. But why does 29 have a tail? And why did 30 close above the 29 low? That's a sign of weakness by the bears. 31, reversal up, good for the bulls. You can call it a breakout pullback buy. And as far as buying above it, even though it's far from the moving average, traders are clearly buying any retest of the moving average. And that increases the chances that the market ends up going higher. Doji, 32, but probably buyers below. 33, small second leg up, forming a tight trading range. Make these bars a little bit bigger. But still not a good reason for bears to be selling, and therefore traders are buying and buying lower. 34, 35, consecutive bear bars, probably going at least a little bit higher. And you can see we just continued to drift up. What about 36 or 37, 38? 38 bull bar closing on its high. Is this exhaustion? It might be, but it's a tight bull channel, which is a breakout on a higher time frame. And even if you buy the 38 close and you just use a wide stop and buy more lower, the odds are high that you're going to make money. But as far as buying the 38 close, putting a stop one tick below 38, I don't think that's worth it. So for me, if I'm going to buy up here on the 38 close, this far from the moving average, when we haven't touched the moving average in more than 38 bars, I'd rather look to buy a pullback. Otherwise, you need to buy, it's better to buy small and add on lower. 39, follow through, good for the bulls, but getting more climactic, so probably more profit taking up here and selling. And then a bear bar, 40, strong enough reversal, second leg down, likely. And then weak follow through, 41, but it's still follow through, and that increases the chances of sellers above. But one of the problems here is 41 is consecutive bear bars. One of the challenges that the bears have is that there's probably going to be is risk reward. If you sell the close and you put a stop one tick above 40, I don't know if you're going to make one times your reward. So that's 1R, and I don't think you're going to make that. And therefore, it increases the risk of more profit taking somewhere lower. 42, bear bar, doji, good for the bear bar, but failed to close on its low, so good for the bulls. Probably more traders buying down here than selling. And the bulls who bought the 39 close and they're looking to buy more lower, they'll start buying once they've concluded that the bears are not doing what they need to do. And you can see 42 is really probably enough of a disappointment bar in a bull trend for the bears that they'll start buying back shorts. So it's really not what the bears want to see. 43, reversal up, but you can argue high one buy, sellers above. I would not. It's right at the moving average, and we have magnets above the 39 high, 39 close. Bear bar, 44. Bears trying to get a second leg down after the sell-off to 42, but probably buyers below. And then bull bar, 45, but a possible double top, 43, 45. Looks like we're entering a tight trading range. And then not a great buy above 45, and a weak entry bar, 46, so it looks like we may go mostly sideways here. Second leg down, 47, good for the bears, but probably buyers below. And then weak follow through, 48. 48, possible micro double bottom, 47, 48. 48 is not the kind of follow through you want to see if you're a bear looking to sell down here. And therefore, that makes me think there's probably more traders buying than selling. And then we got the reversal up, 49, 50, consecutive bull bars, good for the bulls, probably going at least a little bit higher. And you can see the market rallied all the way up to the 39 close, as to be expected. The bears, they were hoping for a major trend reversal, but the sell-off down to 48 was not enough bars, and the rally up to 53 is too many bars up. And that increases the chances that whatever sell-off we get after 53 is probably going to be minor. And therefore, the bears need to do more than what they've done right here to convince traders that we're going to get a major reversal. 55, second leg up after the rally to 53, and then 56, a doji, not a good buy signal bar. You can call it a second entry buy, but top of the trading range, probably going to pull back. 57, bear bar, good for the bears, but let's see the follow through. And then we got weak follow through, 58, and that increases the chances that bears who sold 57 will be disappointed 58 and look to get out break even below the 58 low on 59. Inside bar, 59. Not a good buy, not a good sell either. And then 60, the bears, they tried to get a second leg down after 57, but it's forcing traders to sell right at the moving average, and that lowers the probability for the bears. 61, doji, probably buyers below. 62, bull bar, but a close around the midpoint of the bar. Looks like we're going to go mostly sideways. And then 63, doji. 64, doji. Looks like we're going to be in a tight trading range and possibly for the rest of the day. And then 66, we got a bull break out of the tight trading range. We may get a third leg up, 39, 55, and then a third leg up here with 66. So reasonable for the bears to get out, and bulls okay to buy. 67, consecutive bull bars, good for the bulls, may go a little bit higher. And then 68, a pause. That pause is a sign of lack of weakening momentum, and therefore reasonable for traders to get out after they see the 68 close. 69, bear doji, high one buy, probably sellers above. And then 70, bear bar closing on its low, good for the bears, increases the odds that the market is probably going to pull back for a couple of bars and test down to the 66 low. Weak bar 70, and therefore, if you're going to sell 70, it's better to use a stop maybe twice the range of the signal bar. Too much risk would trigger the sell below 70 and go a couple of ticks up above the 70 high. And that's exactly what happened on 71. 71, outside up, but not a good buy, so probably sellers above. And then 72, it allowed traders out who sold below 70. They sell 70 at 51.5, and therefore 51.25 is their entry price, and the low of 72 is 51.25. So actually, it never let them out. It touched their entry price, but didn't allow them out of the trade. And then we got a doji 73, but that's a warning that bulls are not interested in buying above the highs of the tight trading range, and that makes me think we're probably going to find profit taking into the close. And you can see that's what happened at the end of the day. Give me just 2 seconds here. For stop entries, I thought you could sell below 4, sell below 5. And then for the buys, maybe you buy above 8 or 10 or 11, but really not that great. And then somewhere in here, you can start buying above bars, especially if you're using wide stop scaling in. And then at this point, it's a small pullback trend. You can basically buy above anything if you're willing to scale in at the moving average. So buy above any bar, closing on its low, closing on its high. And then what about buying above 40? You can, but better to use a wide stop. And then I thought always in bulls, okay to get out below 40. Or excuse me, what about buying above 38? You can, but better to use a wide stop. And then I thought always in bulls probably get out below 40. And they can buy again, maybe above the 50 high, betting on a rally back to the 39 close or above 39. Bears, they definitely get out after the second leg down over here. So get out above any bull bar. Bulls, if they're long, they can get out below 57. And then maybe they buy again above 66. Bears, I don't think it's worth selling through here. I'd rather wait for the clear breakout. Bulls, if they buy, really tough to stay long. And at some point, you buy above 66. I think you get out below 70. And there's really not a credible reason to buy again. And then the Bears, they're arguably on the short, betting on a wedge and profit taking into the day. And then this, as far as 77, 78, that's more profit taking for the Bears. Too late in the day to really do anything as far as selling the close or selling below it. For limit orders, I thought sellers above 1. And I thought buyers below 1 during 6, but better to wait for the second leg down. Strong enough breakout, second leg down likely. So better to wait and look to buy below a bar like 7. I thought buyers below 11. And then really, at this point, we're in a tight bull channel. Every time we get 2 legs down, traders buy with limit orders. So a bear bar, 16, strong enough for sellers above the high 1 buy 17. They'll buy below the high 1 because that would be 2 legs down. Sell off, rally, second leg down. And then every time you see a weak sell signal bar, you buy below it. Buy below the 28 low or wait for 2 legs down. 29, rally to the 30 high and then 30 low. So that's 2 legs down. And that's why traders bought the close at 30. And then here, I thought buyers below 42. I thought maybe sellers above, but I think it's better when the market's in a small pullback bull trend. It's better to only look to buy. You'll save yourself from getting trapped into a bad trade. And typically the buys have a better risk reward and higher probability, especially if you're buying closer to the moving average. And then I thought sellers above 56 or 54. And then I thought buyers near the moving average down here. And that's pretty much it for limit orders. You could argue limit order sells up here, but pretty late in the day. Buy the close, sell the close. Most of the day was buy the pullback and sell the pullback. And mostly buy the pullback. Really very few sell the pullbacks. Here, 5 and 6 consecutive bear bars, sellers above, so you can sell the pullback for a second leg down. And then when you see something like 10 and 11, it's not buy the close. It's better to buy the pullback for a second leg up. And then you arguably buy the close in here, especially if you can use a wide stop, but better, instead of buying closes, look to buy the pullback for the second leg up. And then up here, 36, 37, 38, still buy the close technically, but you're getting fairly late in the rally, and the odds are we're probably going to go sideways soon. So the risk is big, and you're probably not going to make 1 times your risk. And therefore, that's why a lot of traders would ended up buying pullbacks rather than buying and holding for a measured move. And that's really probably it for buy the close, sell the close. Let me take a look at questions. A question: when scaling in, do you scale in at 50% of the entry bar versus opposite end of the entry bar? Well, it really depends. I think, scaling in as far as percentages go is an okay way to standardize a process, but it's a lot more effective if you look to scale in at breakout points. So using price action to scale in. What do I mean by that? Well, we have, if you look at, let's say, we have a high 1 buy 24. High 1s typically have sellers above the bar, and therefore that becomes a magnet later in the day. An easier example would be something like let me kind of find what I'm looking for here. So something like this. We have a rally, and then we have a little bit big. We have a bigger breakout bar, and so maybe one of these highs could be potential magnets. The high of this bar, that could be a magnet. And another example would be the moving average. So if you're going to buy the close of, if I'm going to buy something like 39, which most of the time I wouldn't, the risk is just too big relative to the reward. But let's say I bought the close of 39. I'm not going to buy a 50% pullback of bar 39, or I'm not going to buy the low of 39. In this case, if I'm going to buy the close of 39 to scale in, what I'm going to do is this. So let's say I bought the close of 39. I'm planning to add on to the position, but I'm buying something because then I want to miss the move if it keeps going up. So this would be more of a strategy to build a position. You buy the close and you see a bear bar, strong enough bear bar, second leg down, likely. And therefore, I'm not going to buy until I'm convinced that we've had a second leg. Strong enough sell-off, maybe you buy close to the moving average. In that case, it's okay because you're buying close to the moving average. However, strong enough rally, first reversal up might be minor. And you can see what happened. Bears got the second leg down. And therefore, selling a breakout point such as 42 is far more effective. Now, that leads to the argument it's more effective instead to just enter at the scale-in position. But overall, the more the market's in a trend, the more you can get away with just buying and scaling in, at a 50% of the prior bar, or buy the close and buy the low of a bar. But one thing that you have to be careful about is risk. When you scale in percentages, if you buy the close of 28, I think a good rule of thumb that Al talks about that I agree with is look to scale in a scalp distance away from your first entry. So if you're going to buy and scale in lower, look to scale in at least 4 to 5 points below your original entry. And if you're going to buy and add on to a position that's going your way, look to add on 4 to 5 points away from your first entry. Is a 20-minute EMA, exponential moving average, important on a 15-minute chart as it is on a 5-minute? Yeah, really, a moving average is just an average price. I could change this to anything and it would still work. I could do a 10-minute moving average and it's still going to work the same way. Here, obviously, it's 10 bars, so it's going to be much more glued to the current price, but I can still use it. I can use a 30 EMA and it would give me the same thing. 20 is a common number. Why is 20 a common number? I have no idea. But the reality is, I know a lot of traders use it. There's a lot of documentation on the internet about it, or people, or books and whatnot. But the reality is, it's just an average price. And it really doesn't matter which input you use. But they're going to be relevant on all time frames. How do you know if pullbacks are profit taking or bears trying to bring the market down? Well, it really depends on the scenario. But the way I look at it is this. Let me show an example. So here's an example of when a pullback is leading to an actual reversal. We have a rally, pullback, and then it formed basically a lower high major trend reversal. And look at the reversal. It formed a series of strong bear bars closing on their lows with open gaps, and therefore it trapped traders. If you bought anywhere over here, so if you bought below 1 and you scaled in lower, you got trapped. and you got trapped into a losing position. And that's what I think about is the sell-off forming uniform bars on the way down? In other words, is it trapping bulls who buy below bars? Or is the sell-off relieving the bulls? And all the way up, every sell-off relieved the bulls. If you bought here and you were disappointed, it had a deep pullback allowing traders out. And that deep pullback causes more bulls to buy the second leg down. Bear bar closing on its low, bears had a chance to get a strong sell-off. And what happened? They got a weak bar, 41, and then a disappointment bar, 42. So there's profit taking to the downside. In order for a strong reversal to happen, you need traders to sell below 1 and sell during this bar 2, and you need them to keep selling all the way down. You don't want them to start taking profits. That's what happens in pullbacks. The reversal attempts, but in this case, if it's a bull rally, the reversals to the downside, bears end up taking profits and bulls start buying. And that leads to profit taking. So instead of getting strong bear bars closing on their lows, traders are buying back shorts and bulls are buying with them. In some trends during the trading room, you're able to identify there's something too weak or wrong with the trend that it could just crash down. How do we differentiate those? Yeah, usually it has to do with the moving average. So basically what this person's asking is, how can you tell this is going to be one of those trending days that can last for most of the session versus one of those trend from the open days that get a reversal? And that usually has to do with the higher time frames. So let me see here. So here's an example of a bull trend from the open, but bad higher time frame context. We have a rally, and bears, obviously there's more overlap on this day. But what do you notice? The rally is just not as strong. And look at this. This is the 60-minute chart. This rally is testing the upper third of a trading range on the 60-minute chart. And what happened? This was just a bull leg in a trading range on a higher time frame, and it led to a sell-off. Good higher time frame context. We have a bull trend from the open that lasted all day. But look at the 240-minute chart over here. This bull bar right here was this right here. So we were already in a tight bull channel on the higher time frames. If you go back to today, we're gapping up. So we're breaking out above a trading range. And that made me think that even though we have a wedge, 1, 2, 3, the bulls may end up preventing the bears from getting a strong reversal. And so that was part of my thought. My thought was, I thought a few things. One, I thought there was potential for the day to sell off and the market form, maybe close below the midpoint of the day. I think I talked about that, maybe over here, that we could sell off back to the 4 high. And I made the comment that when we saw 40, that there was that possibility. But this was not enough selling pressure to the downside, and it was probably a minor reversal at best. And what that means is, because it's a minor reversal, what that means is that increases the odds that whatever rally we get is not going to be enough to get a higher high major trend reversal. So the bears, they need more selling pressure than this. So I hope that answers the question. So where do we go tomorrow? I think tomorrow is going to be disappointing for the bulls. We may not get a reversal down tomorrow, but I suspect that tomorrow is not going to form a strong bull close, and it'll probably be something disappointing on the day. It'll probably be disappointing for the bulls, and I suspect we probably will not close above the high of today, but we'll see. I suspect over the next several days, we'll probably find profit taking and have to test back down to somewhere in here. All right. Thanks everyone for tuning in, and I hope everyone has a great rest of their day.